Hello traders, in this video we're going to talk about two powerful price action setups that you can use and apply in your trading. These setups are simple, but they're very powerful and they are based on price action. They don't require indicators to use it. Now, the first setup is a two-legged pullback, second entry as a high probability setup. Market likes to move in pairs of twos. For that reason, any two-legged pullback combined with the proper market structure at the proper key entry point, and key entry point is trend line, support, resistance line, or exponential moving average, is going to create a high probability setup. Second entry at the key entry point is a high probability setup with the proper market context and with the direction of a trend. It sounds simple, but that's how price action likes to move. And if you learn to train your eye to spot these two-legged pullbacks, you are in an advantage against other traders. Now, the second high probability setup is a failure of this two-legged pullback. And you may be a little bit confused now. Hold on, the two-legged pullback, it is a high probability setup or not? It all depends on the market context. If the trend is still in play, the two-legged pullback at the key entry point is a high probability setup. If the trend is no longer in play and the context is telling you that you don't want to take the two-legged pullback, then you can treat it as it's going to be a good trap and you can take the failure. And don't worry, we're going to show everything in today's video. And today is Friday, February 18th, and we're looking at S&P 500 mini futures, and we're looking at 2000 tick chart. And as a day traders, first thing we need to do is we need to identify the current market structure. And right off the get-go, I can see that this is a bullish move up and bullish move down, and this is instantly indicating a trading range. So as a price action trader, I need to locate my low of the day and the high of the day, because these important key levels will a lot of times come into play. Now, today started with the two conflicting patterns because there is a downtrend working lower and there is a break, and after there is a break of a trend line, according to trend line rules, you expect for a new extreme to be formed. So this is the pattern number one. But also there is a second pattern. There is a false breakout below the key level in trading range, and most breakouts in trading ranges will fail. A lot of beginners traders, they will like to sell the strong bearish momentum because they see the momentum pushing lower, but a lot of professional traders, they are fading these breakouts because they know that most breakouts of trading ranges will fail. There's a higher likelihood that the price will pull back. So as the price is pushing higher, and this is the lowest low, this is where you start counting for your second entries. You have a first entry short, pullback, second entry short. But is this second entry short a good entry to take? We have two conflicting patterns. So which one is most likely going to work? Well, the best thing to do if you're unsure, just sit on your hands. But the bigger pattern in price action, most often than not, takes precedence. So the bigger pattern is trading range. This trend line is shortened. So as the price is pushing back above the support and above the EMA, which is very important, this tells me that this false breakout is strong, and false breakout will a lot of times generate strong momentum to push back into trading range. So I'm not looking for price to create new extreme. I'm looking for the opposite. I'm looking for price to come from the failed breakout and back into trading range. For that reason, even though you have a second entry short, it pushed above EMA, and you can treat it as a failure because you're very close to support, you're coming from failed breakout, and you can take it as a failed second entry short. This bar is big bullish bar. You're at the key entry point, you're at the exponential moving average, and the context is telling you it is a range and you're heading back up into a trading range. This trade was a little bit tricky. If you had a big bearish bar right here, it probably confused you a little bit because you have a shortened break and a new extreme of the uptrend, but you have to take into consideration the overall bigger pattern and the fact that you came from the false breakout. Now, so this is the failed second entry short. This is the high probability setup number two. It's easy, but that's what it looks like. Now, the EMA is no longer holding price. So you would expect for price to keep pushing higher, but in fact, we're pushing lower. And you have a new high, first entry long, pullback is second entry long. But can you take the second entry long? Well, you can't take it now because now you push below EMA. So even though you're at the support, you're below EMA, so you cannot go long just yet. And can you take the failure? The failure was very tempting. It was a very similar pattern to what we had yesterday. If you take a look at the structure, you take a look at a new high, first entry long, pullback, second entry long, failure. This is second entry long below EMA, but it is at the support, and they like to trap traders like that a lot. They like to create a second entry long that is below EMA, but it is at the support. Similar pattern right here. I was really tempting to go short here, but this time you're not touching the EMA as the last time. And this support is area, it's not just a line. So you don't want to be going short directly into these lows. It is better to sit patiently, even though this failure would have worked, but it's better to sit patiently. So hopefully you are taking into consideration the context. Once again, market likes to move in twos. As the market keeps pushing higher, you guys can see that the EMA is starting to get flat. It's in the middle of these bars and prices is congesting. So you're just sitting patiently. You're most likely just waiting for price to create some sort of trend so you can take advantage of the two-legged pullback. This is the first leg that price created from the false breakout. You're going to copy it. And there's the second leg that price followed into a new extreme break of uptrend, new extreme form. Once you see this new extreme form and price is reversing back down, you're expecting for price to create a lower high or failed second entry long so you can head from this top of a trading range all the way down here. But it never set up. Price just went from the resistance back to the support and we're just going up and down, EMA is completely flat. So you're applying the trading range rules. You're sticking to shortened trend lines and you're being very patient. Move up. Once again, you're expecting some short entry. You never get short entry. There's a shortened downtrend, little break, new extreme, potential false breakout, because now the structure is a small trading range and also the bigger trading range. So you not only you broke from the mini trading range right here, also you're breaking below the major key level for the day. So chances are really high you're going to pull back up. However, you're not that far from EMA and you can make additional push down. It is safer to just wait a little bit for better entry. As the market is pushing higher, you get a high low setup, which is confirming the overall context that you're coming from the failed breakout, probably back to this resistance. But this is a horrible bar because half of the bar is a bearish stim, which means once the bar was closing, everybody started selling. So unfortunately, the bar is not great. Had the bar been a little bit better, this entry would have been much better. Now the market is pushing higher, and this is the lowest low of this move down here. So you're counting first, second entries from here. You have a first entry short, pushed above EMA confirming bearish momentum, and you have a second entry short. Now, is this second entry short a high probability pattern? It's not, because this is not a downtrend. In fact, this is an uptrend that is coming from the false breakout. So this tells me that the second entry short is going to be a trap. Market likes to move in pairs of twos, but you have to combine it with the proper context. Trend is up. So I'm not looking for second entry shorts. I'm looking for second entry shorts to fail. So there's a nice failed second entry short, but you're far away from EMA. And you can get trapped like that a lot of times. It confirms the trend line. Small little bar, aggressive trader can take it, but it's really better if it touches the EMA. So the win percentage of this entry is really increasing. So this is not a high probability setup per se just yet. The market is pushing higher. And now that you have this strong bullish structure, you created a new high, first entry long, pullback, second entry long, but you're extremely far away from EMA. So even though the structure is bullish, you're so far from EMA, you're most likely going to pull back. It is inevitable. Also, 1, 2, 3, 4, 5, 6 bars, 7 bars stacked next to each other. This is micro congestion. So that tells you that you cannot just pull trigger on every second entry you see. You cannot take second entry short against the trend, and you cannot take second entry long with the trend if it's at the wrong time, at the wrong context. You're so far away from EMA, you're in this congestion, you cannot take this entry just yet. And overall structure is trading range. And if anything, you broke above this micro trading range. So you may expect pullback down into the middle of the trading range. Now, there's the short-term downtrend working lower. There's a little break, 2 legs to a new extremes to the downtrend, which tells you that the downtrend is over. And there is a move to a new extreme because price broke this uptrend and finally created a new extreme. So after you have a new extreme, you can consider this uptrend to be over. When I was watching this live, I was really tempted to go long on this higher low, new low, first entry short. It is a high low. EMA keeps holding price, but the signal bar was horrible. Had this bar was much more bullish, I would have probably went for a scalp here because I still expected a new extreme to be formed after break of this trend line. But price stalled a little bit, created 2 legs down, and then reversed it back up. So now that you see that the price created a new extreme, what you're expecting a reversal or correction, because this uptrend is no longer the pattern in play. And if you take a look back, and if you zoom out a little bit, you can see that this trading range is starting to have a bearish imbalance. We're making series of lower highs. Even though these 2 highs are a little bit higher than these, it's still a lower compared to overall structure working down. You can even find a potential trend line that is going to represent the imbalance, but you can see that there's a bearish tilt in this trading range and you can barely make it to the middle of this trading range. So after you're pushing down like here from this double top and you barely made it to the middle, this tells you that there's a bearish imbalance and you're most likely going to break to the downside. There's the new high, there's the first entry long, pullback, second entry long, failure. What is the context? Context is bearish. Uptrend had the break in new extreme, strong push below EMA confirming bearish momentum. Any second entry long is going to be a trap. Why? Because the downtrend is starting and the uptrend is over. So price action likes to move in pairs of twos. You want to take high probability setup, and this second entry long failure is a great high probability setup. This is my first trade for the day. Happened very quickly. Great bearish bar. You're right at the exponential moving average. This is a great reversal pattern if it occurs right at the exponential moving average. And this is the variation of a two-legged pullback failure, but the context is not telling you to take this long, it's telling you to take this failure. Price keeps pushing lower. As the price keeps pushing lower, you guys can see that you're breaking below this support. And now we talked about that most breakouts of trading ranges will fail. It pulled back into trading range here, it pulled back into trading range here. Why this trade right here didn't pull back into trading range? Simple answer. There's a bearish imbalance in play, and there is a downtrend working lower. As long as this downtrend is in play and there is no new extreme, and if you combine it with a bearish imbalance, you can treat it as this breakout will most likely succeed. Now, doesn't mean that you want to sell, and you can still even buy it because you're still a little bit far away from EMA. And when you're watching this live, you have a probably short-term trend line like this, so you have a little break and a new extreme, but the bearish imbalance is the main clue right here. It's not really about the trend line per se here. It's really the fact that price is really strongly bearish here. So as the price is pushing lower and finally confirm this trend line and push all the way back down, and now you have this downtrend confirmed, and now you're for sure expecting for downtrend to start. So when the structure is bearish, what's going to be the high probability setup? Is going to be a two-legged pullback at the key entry point. There is the new low, first entry short, pullback, second entry short. So we have the structure, which is now a bearish downtrend. We have the key entry point, which is the exponential moving average. We have the good behavior, which is a bearish signal bar, and the uptrend played out. This is important because the shortened trend lines follow the same rules as the bigger patterns. So there's a break, new extreme form indicating that the uptrend played out, and that's when it's safe to sell. After break and new extreme, at the EMA two-legged pullback, that's the easy high probability setup. It looks very simple. It looks very easy. It takes time to combine it with all the structure and all the bars that are printing on a chart, but this is the basis of what you're looking for. You're looking for these setups that are considered high probability. Market created new extreme because after a break, you expect new extreme to be formed, and then you expect correction or straight up reversal. There is a new low, first entry short, second entry short, another two-legged pullback. Market likes to move in pairs of twos, big bearish bar. I'm not marking this as a high probability setup because you right now formed a new low and you can reverse from here. This is not a high probability setup. You don't know that it's going to work. It worked in this time, but next time it's going to rally up above EMA and you're going to be wondering why the second entry short fell. Well, it fell because you already had a new extreme. So you cannot foresee the future, so you cannot take the short. Market then created a lower high, and I orderly marked it as an example because the signal bar is not that great. It's quite big. Your stop loss has to go above this bearish bar right here, and there's a little stem at the bottom. So I'm just going to delete it, but this is, had the signal bar been much better here, this would have been a great lower high, because lower high is a confirmation setup of this two-legged pullback because EMA keeps holding price. And after that, you have a new high, first entry long, second entry long failure. Once you create a second entry at the key entry point, once you create a two-legged pullback at the key entry point, that's when you can reset the count. So you have a new high, first entry long, second entry long, failure. Downtrend is in full effect, EMA keeps holding price, and this is a big bearish bar. So this is a failed second entry long. And once again, second entry long would be a great entry in uptrend, but this is a downtrend. So you can treat it as a failure. And market keeps pushing lower. After you created this big leg down, this is when you probably are looking for bigger pattern, or this is what I was looking. I was looking for pattern like this. Now, when we are looking at this pattern, the structure is still bearish downtrend. And in bearish downtrend, we're looking for two-legged pullback at the key entry point. So the market push lower, form a new low. This is where you reset the count, and you have a first entry short, pullback, second entry short below this bar. You are not at the key entry point. The structure is okay, but you're far from EMA and you're far from trend line. So there's a second entry short. It failed because it's far from EMA. Same thing right here. There's a second entry long in uptrend, but it's far from EMA. It failed. All right, it's important. You have to have the context on your side. Now, price continued pushing higher and created a beautiful double trap entry. This is a double trap because everybody who went short too early got trapped, and everybody who went long too early in downtrend, they got trapped as well. However, this is really big bar. This is double bar entry. Your stop loss has to go all the way above this bearish bar right here. Excuse me, above this bullish bar right here. So you're entering at these lows. Stop loss goes all the way up to here. Risky entry and not a good risk to reward ratio. Now price created a lower high, and just like in this instance, a lower high is a confirmation setup of this pattern. Also on a larger pattern, this looks like a two-legged pullback. First leg pullback, second leg. Also you have an uptrend with the break and the new extreme form. Exponential moving average as a key entry point holds price, and this is a gorgeous lower high entry. So this is my third trade for the day. 1, 2, 3, easy price action, easy downtrend. This is what you're waiting for. The goal is to wait out these areas where it's choppy, where you don't want to be guessing, you don't want to be gambling. After market gives you a clean structure and clean two-legged pullbacks, this is where you can take the entry. You have a new high, first entry long, second entry long failure, but you're at the very low of this down move. It can be considered a good entry, a definitely great signal bar. You can still treat it for a scalp, but given the fact that you move so far down, you have to be careful that, because you now just bounce from this trend line, so you never know when you're going to break. So a little bit advanced, not a bad entry, but you have to be a little bit careful shorting all the way down to these lows, but decent entry nevertheless. Now the market is reversing higher. So as the market is reversing higher, you're going to draw the short-term trend lines, and now you have two conflicting beliefs, because you have a first break of this uptrend, so you expect new extreme, but you have a first break of this downtrend and you expect a new extreme for the downtrend. So when I'm watching this, I know that the bigger pattern most often than not takes precedence. So I was honestly watching and expecting new extreme to be formed. I was expecting new high, first entry long, second entry long failure, and I was expecting for price to go lower, but it didn't happen. In this instance, downtrend already played out with the break and a new extreme. This resumed the uptrend, finally formed a new extreme for the uptrend, and now you know that this uptrend is no longer in play, and then you can resume and look safely either for a lower high or failed second entry long. Lower high, gigantic, unenterable, failed second entry long, far away from EMA, already way too close to these lows. You're expecting, according to context, to get a new low for this downtrend. Uptrend already played out, but this is unenterable. This is so far away from EMA. But hopefully you understand once again how price likes to move in pairs of twos. First leg, second leg, new high, first entry long, second entry long failure. This second entry long is going to be a trap, is more likely going to fail because structure is downtrend, context is downtrend. As you created new extreme, what you're expecting correction or straight up reversal. So you're going to draw the trend line, you have a break of a trend line, new extreme is only a first entry short, and new extreme has been made. This tells you that the uptrend is no longer in control. Price reverse down from here. As you have a price reversing down and you have a multiple bounces right here, that's when you can find a possible trend line like this, and you can copy it at the bottom and it fits really nicely at the bottom. So this looks like that the channel has flattened out. This was a little bit of a spike and price went into a channel. So the bias is still bearish. After you have a break in your extreme, you're not looking for longs by no means. You're looking for first entry long, second entry long below EMA. You get a lower high, but it formed above EMA as a bullish doji. So this is not a great entry. Price pushed below EMA, which is good, confirming the bearish momentum, but then right afterwards pushed back up above the EMA, which is a little bit confusing because really, if you want to take failed second entry long, you're supposed to close below EMA. So you have to be a little bit patient here. Once again, decent entry context wise, but you really want for price to close below EMA. You can reset the count here and you have a first entry long pullback, second entry long failure. The structure is downtrend, you're below EMA, and this is a great big bearish bar. So the price keeps making these two-legged pullbacks. It's simple to see, it's simple to spot, but this is what you're looking for. As the price pushed lower, it created a new low, and there's a first entry short, pullback, second entry short. Another two-legged pullback, but is this good? Is this a high probability setup? Well, it's not, because the short-term trend line is in play. EMA holds price correct, the structure is bearish downtrend correct, but the bar is big bearish bar correct, but you have to respect the short-term trend lines. A lot of times on the balance of probabilities, if you keep respecting the short-term trend lines in the long run, you will come out on top. So I recommend sitting here on your hands, even though you have a little bit of overshoot, which leads to a break of a trend line or straight up reversal, which may tell you that you're probably going to break lower. It's better to respect the trend line because you never know if you're going to make a break. And in your extreme, better to sit patiently on your hands. Market continue pushing lower, created a new low, and there's a first entry short, second entry short. In this time, uptrend had a break and a new extreme form, but the exponential moving average keeps holding price. This is the first leg, pullback, second leg. Another two-legged pullback with the direction of a trend. Great reversal bar. This bar, as it was forming higher, at the very close of the bar, everybody started selling, and this is indicating strong bearish momentum because this big bearish stim represents at the very close of the bar, a lot of sellers jump on board. The exponential moving average keeps holding price, and this is a beautiful second entry short. Once again, the structure still downtrend and beautiful entry. As price keeps pushing lower, and it is only the first entry, it bounced off the bottom trend channel line, and these channels, they serve as a trading ranges. Price is just oscillating up and down, respecting both key levels. So this is basically a flat trading range. A little bit, you can treat it as such. So as we're coming from the lower trend channel line, you're expecting for price to go at least to the middle of this channel or back up to the trend line up here. There was a strong bullish momentum, and this was really confirming that you're really most likely heading higher. So at this point on, once you're coming from the very bottom of the channel, you really want to be careful about shorting. And you guys can see a lot of shorts got trapped because everybody who went short here, they keep their buy stops above these highs right here because they sold their position. So in order for them to get out of their positions, they need to buy back. So this was a huge bullish rally. Everybody got stopped out here, indicating strong bullish momentum. You have a new high, first entry long, pullback, second entry long. Also, new low, first entry long, first entry short, second entry short failure. So this is a confluence of two patterns. Second entry long after strong bullish move up, and a failed second entry short. We treat it as a failure after first bar in the opposite direction. Second entry short triggered below this bearish bar, and this is the first bar in the opposite direction. You cannot afford to wait for this second entry short to fail. You don't know it's going to fail. When you're going long here, you don't know it's going to fail, but you treat the context as it most likely will. Because if you wait and you enter at these highs, the scalp has already been made. So EMA keeps holding price, potential trend line keeps holding price, strong bullish move up, you're coming from the bottom channel, second entry long, and a failed second. Now as the price keeps pushing higher, you have a confirmation of the trend line right here, but you cannot take the short because this uptrend is still in play. All right. You cannot just take a short just yet. This is a strong bullish move up. This pattern, this uptrend is still in play. So you don't want to be taking any shorts. You don't want to be necessarily taking any long as well. You have a new high, first entry long, second entry long, but you're very far away from EMA. You don't want to happen the same thing that happened right here, second entry long, far away from EMA. So you follow the rules, you trust the process, and you don't cherry pick. You're far away from EMA here. So even though you get a second entry long to like a pullback, you're far away from exponential moving average. Okay. Price created a new extreme and gave you a first entry long, pullback, second entry long. This is a third confirmation of this trend line. So this trend line is now confirmed. EMA keeps holding price, and this trend line that acted as a resistance now acts as a support. So you have multiple key entry points. You have a two-legged pullback, second entry short with the direction of a trend, decent bar, high probability setups. Now, if you are confused whether you're going to create new low or you're expecting for price to keep pushing higher, you're just sitting on your hands because this is the bigger pattern, so you're most likely expecting for price to create new low. But if you have so many key entry points holding price, since you came from the very bottom of this trend line and such a strong bullish move up, you can definitely expect that the price will continue pushing higher. So if you're a little bit advanced, you can take the second entry long, and if you're not sure which pattern you play, you're just sitting patiently on your hands. There's a strong momentum pushing up. When I was watching this live, I had my trend line like this with an overshoot. But as I'm looking at this really makes price fit better, because if you have a measured equal overshoot, this really tells you that you got your trend lines correct. And this is an overshoot, and this is a measured break perfectly. Now, what is an overshoot? Overshoot is unnatural activity in the market. It is overbought territory. Now, you don't need no stochastics, RSIs, none of that stuff. You can see how steep it is. You can see how you're breaking the trend line to the upside. You can see how far away from exponential moving average you are. Overshoot, you expect a break of a trend line or straight up reversal. Okay, market is pushing lower. you have a break, new extreme for the downtrend, and you have a second entry long, new high, first entry long, second entry long. Can you take the second entry long? No, you cannot, because you're below EMA, you're below trend line, you're not touching the trend line, and you're coming from the overshoot. So even though you have a break and a new low, you're coming from overshoot, you're below all the key entry points, you cannot take entry. Can you take a failed second entry long? No, you cannot take failed second entry long as well, because downtrend played out with the break and a new extreme. The bigger pattern is uptrend, and you may create a new extreme. You're not sure whether the overshoot is going to be that strong, is going to push lower. A lot of times traders think, okay, if I'm not buying, that means that I'm selling. No, it is not black and white. Sometimes there are areas on the chart where you don't do anything. There is no long or no short. You're just sitting and you're waiting for price to resume to give you a cleaner entry. So this is the area where not shorting and not going long is the right move to do. Price created a second leg to a new extreme and a strong bullish move up. This strong push above EMA confirmed that this bigger trend line is valid. Break of a trend line, so you're expecting according to trend line rules to create a new extreme. You have a new low, first entry short, strong push above EMA, second entry short failure. This is once again the two-legged pullback we talked about. Second entry short, but you're in an uptrend, so you're expecting for a second entry short to fail. EMA keeps holding price, and this is a nice reversal pattern. Now, you cannot go long above this bar right here, and by the time you have this bar right here, it's way too big. I believe you didn't get the chance to retrace. It first went down and then it broke and continue higher. So this is a 5-point stop loss, but this is context-wise great entries. Failed second entry short, EMA is holding price. You expect for price to create a new extreme. Price created a new extreme. So after that, you expect correction or straight up reversal. Perfect price action. Price pushed below EMA, new high form right here. First entry long, pullback, second entry long, failure. Now, when I was watching this, and I made a little bit of mistake because I had my trend line tight like this. But when I have a break and a new extreme, I'm not supposed to be drawing it tight. I'm supposed to be anticipating wider pattern because we're most likely going to get a reversal. Now, this entry was still very hard to take because this just set up the trend line. You don't even have a clue that the trend line is going to be wider. But advanced trader can expect that after a new extreme, after strong push below EMA, you can expect a move in the opposite direction. So this is a failed second entry long, nice bar, little bit advanced, but this would be a great entry if you can understand the context perfectly. It's still a bit too late, but the context wise, this is perfect. Third swing confirmed this downtrend. So this is now a strong downtrend. And now, as this is a strong downtrend, what do we expect? We are looking for two-legged pullback at the key entry point and price form new low, first entry short, pullback, second entry short, first leg, second leg, first break of a trend line, you expect new extreme, you're close to key entry point, big bearish bar, uptrend played out with the break and new extreme, simple price action, textbook entry. Price created a break, first leg to a new extreme, pullback, second leg to a new extreme, strong reversal up and market closed. So today, a lot of textbook setups, trend lines are working almost perfectly after break new extreme, new trend, break new extreme, new trend. I like these days when price action is not making you second guess your analysis. It's really following the rules perfectly. There has been a lot of great entries, a lot of gorgeous bars, just a great day today. Hopefully you guys had a great day today as well. I'm just quickly going to talk about this setup right here because when I'm looking at the second entry short, I don't want to go short here at all because I'm above EMA and I have a horrible bar. But the trader had a much better bar. He had a bearish bar that closed, excuse me, something like this is the big bearish bar that closed like this, big bearish bar, but the bar was way too close to the low of the day, and you're coming from the false breakout in the bigger structure as a trading range. So even though you have a breakout in your extreme and you're at the EMA, this was confusing pattern. If you took the second entry short and you got trapped, understandable, I can definitely see why, but you just have to focus on the bigger pattern. And the fact that you're coming from the false breakout and the fact that you're so close to the key level low of the day, you really have to be patient and you really just cannot short just yet. But this was a tricky entry because even the uptrend had a break and the new extreme. So fortunately, my signal bar looked horrible for me to go short. But the fact that you're coming from the failed breakout tells you that you're most likely heading back above the key level, back above the EMA, and you're going to be in the trading range. All right. So hopefully you guys found this video useful and enjoy the weekend. I'm going to see you guys in the next one. Take care.